We bought into China last summer and also we invested heavily in October last year. So we're now sitting up on sizable returns. But our expectation is, Susan, that the Shanghai Composite, although it is going to be volatile, the trend will probably remain up for another 12 to 18 months. We simply think that the valuations, although they are very high on some of the securities, especially in Shenzhen, when the mob takes over in China, valuations get tossed out of the window. And we saw in the previous bull market between October 2005 and October 2007, the Shanghai Composite went up by 500% in 2 years. We had maybe 3 or 4 consolidations of 10–15% along the way. So far this bull market has also acted in a similar fashion, although it has been volatile. But the consolidation phases have been brief and shallow, and the uptrends have been pretty fantastic. So we don't think the Shanghai Composite has done anything at this stage to convince us that the trend is over.
But when Shenzhen becomes more of a talking point, when access to that market becomes available, and you put it all together in the China universe, the average PE starts going up, stocks start going pricier, because that's the new economy stuff there. We're also in the midst of the rollout of a lot of IPOs, and there are hundreds and hundreds still backlogged, ready to hit the market. Is there liquidity? Is there liquidity when we're facing a possible, like a Fed-led interest rate hike cycle, to absorb all those new cash calls that are going to be coming for some time to come? There
will obviously be more supply of stock with these new IPOs, but I think there is enough interest in Chinese assets at the moment to suggest that this liquidity will come. We've seen fund flows into China at a record pace. Retail investors are basically leveraging and investing in China. And I suspect that once China is actually overweight, or their stake in the MSCI index, emerging market index, is increased over the next 12 months, you will see even more fund flows into China. And if you look at the last bull market, Susan and Bernie, we saw that the Shanghai Composite did absolutely nothing for 4 years, from 2001 until 2005. So for 4 years, the Chinese stock market went down when the rest of the world went up. Well, this time around, we've seen something similar. The Shanghai Composite fell until 2014 when the rest of the world went up. So Shanghai is always a late cycle mover. It tends to move late, and then the moves tend to be quite spectacular. If history is any guide, I wouldn't be surprised if the Shanghai Composite doubles from here over the next 12 to 18 months.
And then falls back down.
It will fall back down, don't get me wrong. We will have a world-class bust.
That's fun, though, if it can double. You're going to have fun going up.
Puru, I know you're... I would say you're kind of a conservative investor. Is that a good way to describe your philosophy?
Well, we follow a risk management strategy, a stringent risk management strategy. So we protect every position with trailing stops, and we never override the system.
I was going to pick up on that, especially because I know you put in some pretty tight stop-loss gaps, right? I'm just wondering, in this volatile environment, what is a stop-loss gap for you? Is it 5%? Is it 10%?
Well, usually it depends on the position. So we, in our equity portfolios, which we manage for investors, we have, say, 5% in each position. And then we look at the volatility of that stock on a daily basis, and we multiply that by a number of days, and we use a multiple of that. So it depends on the volatility of each security that we own in the portfolio. But typically, it's anywhere between 8 to 12% from the price.